Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. With earnings season in full swing, we continue to look out for potential catalysts within the markets. Now, it's notable that we've just seen a week that's been absolutely dominated by big tech. And it does feel like we're over the hump within earnings season. That is certainly notable when you look at the breakdown of exactly when the earnings are coming. And you can see that the vast majority of it is behind us now. We can start to move towards the back end of the second quarter earnings season. Does that mean that all of the volatility is done with? No, not necessarily. And certainly there's plenty of volatility anyway within the markets. And there's been a massive focus on big tech names and companies that even have performed very well and outperformed expectations, still seeing significant declines. Then we see the ISM manufacturing PMI and markets selling off once again over fears around a recession, with jobless claims also on the rise. Let's look at some of the key factors to consider within earnings season thus far, and then look out for three stocks for the week ahead. First and foremost, this is the S&P 500. Now we're sort of midway through Thursday, so we haven't seen all of the data for Thursday's companies. We haven't seen Fridays either, but generally Fridays are relatively quiet. We have got a couple of the big oil and gas names in particular to look out for on Friday. But certainly, as you can see here, as things stand, 68% of the S&P 500 having reported already. You can see as a whole, it's the earnings that they have managed to outperform on, much more so than revenues. And in actual fact, I would say that the revenue side of things is the side where we've seen very mixed outcomes, essentially. I mean, you can see here that, you know, a number of these different sectors have got sub 50% revenues. So we're talking about companies that have either beat or missed first expectations. Very mixed on the revenue side of things. However, on the earnings side of things, you can see, and this is something we were pointing out a week ago, healthcare doing particularly well. 95% beat on earnings, 81% on revenue. So that's a standout performer from a sector basis. You can see energy coming into this ExxonMobil and Chevron announcement. They've been doing relatively well, 75%. Materials, industrials, both beating heavily on earnings. So again, you're talking about physical goods here. You're talking about commodities. Technology also doing well, 81% beating on earnings, and revenue 76%. So, you know, there's been major concerns about a potential slowdown in the tech sector, but as you can see there, technology doing very well thus far. This is a chart that I brought up last week. It's from Earnings Whispers. Certainly follow them on Twitter. Great account. And what you can see is that the week just gone was the biggest week for second quarter earnings. And you can see whilst the week forthcoming, you can see this August 6th week, does have a decent chunk of companies reporting. It does feel like it's the right shoulder of a head and shoulders formation within earnings season, because it starts to really tail off beyond this week. So this is the final sort of really big week before we start to see things tail off in a meaningful manner. The first company I wanted to bring up is Caterpillar. Caterpillar, of course, heavily ingrained in the manufacturing sector. It's notable given the fact that we've seen this report in terms of ISM manufacturing with a sharp decline on that reading. Doesn't necessarily fill you with confidence for companies like this. But there is a view that with the possibility of Donald Trump coming into power, the possibility of increased tariffs on goods from abroad, that manufacturers in the US should do well. The view in terms of market estimates on an annualized basis or annual basis is that we should see some growth. It's not necessarily going to be outstanding. 21 in terms of earnings for 2023. That's expected to rise to 21.61, then 22, 24, 24. So gains, but nothing too outstanding in terms of earnings. In terms of revenues, largely flat. You know, ultimately in 2026, we're hoping to get up to 72 billion. We're at 67 at the moment. So some gains expected, nothing particularly outstanding as it stands. And in terms of performance against expectations, somewhat mixed. You can see last time around, we saw sort of outperformance on the earnings, underperformance on the revenues, but that's on an annual basis. You can see in terms of the quarterly basis, earnings have reliably outperformed. You can see the past 5 quarters, we've seen them outperform earnings estimates, and it's revenues that has been relatively weak, and that really sort of tallies up with what we've seen in terms of the overview. Generally, it's companies beating on earnings, not necessarily faring as well when it comes to revenues. This time around, we're expecting 554 on the EPS figure, 16.76 on the revenues figure. But as we can see here, earnings expected to gradually tail off in the coming quarters. 554 down to 528, down to 519, rallying back up into the first quarter with a 571 figure expected. In terms of the share price, let's just bring up the chart. I'll go full screen here. We can see that if we look back at the last earnings report that we have, we've got essentially a sharp decline and then a recovery and a close of that gap. That often happens with reports that see I wouldn't say relative weakness, but that are taken poorly. If we see a sharp gap towards the downside, a lot of the time that's recovered. Gaps towards the upside often aren't closed. In terms of the recent trend, it's notable because we've got this downtrend, but we've seen a rally up through your first port of call, this first resistance mark here, which is 364. That points towards a possibility that this retracement phase is over, and we've pulled back into the 76.4 alongside these sort of ascending trend lines. We're moving through that confluence. Certainly the fact that we've got that poor ISM manufacturing PMI, certainly not helping this company considering how heavily entrenched it is within the manufacturing sector. So a break below this 321 in particular would be very notable and point towards a continuation of that bearish trend that has been playing out since that April peak. But, I would say, if I'm just reading this from a charting perspective, that rally up through 364 points towards possibility of this being a retracement. But as things stand, we're starting to blow through levels, the Fibonacci level, trendline support, that confluence of trendline support really coming into play will be very important here. And if we start to take out these swing lows, then it looks like the bears are likely back in play for Caterpillar. In terms of the next stop that I wanted to bring up, it is Uber. Now, Uber, we can see, let's just take a look at this. So we can see in terms of from an annual basis, it's a particularly interesting stock because we're moving from being loss-making into being a profitable company. And you can see on the EPS expected to go up to 0.88, 212, 301, 377 over the coming years. So this is a transformational period for Uber. The growth of revenues, certainly important within that, expected to grow from sort of 37 billion up to 63 billion in 2027. So over the next, say, 4 years, we're expected to almost double revenues, and we're expected to see earnings per share going from 87 cents up to 377. So clearly improving margins within that. That pathway takes place from the following quarter rather than this one, according to estimates. And you can see this is expected to be a low. You can see the expectation of 134 down from 153. But if we're looking in comparison to last year, 126 up to 134. So still growing on a year-on-year basis. Certainly a cyclical business. As you can see, these peaks in the first quarter are their financial year's first quarter. And then we generally sort of base out from there on in terms of the revenue side of things. 84.17 again, if we're looking in terms of the comparison to last year, 81.80. So again, growth from that perspective as well. But when you've got these cyclical businesses, generally it's important to compare it on a year-on-year basis rather than just looking at it from the perspective of comparing it to the prior quarter. In terms of market estimates, you can see that analysts on Wall Street heavily on the buy side of things here. Price targets, the most recent price targets we can see here, 100, 95, 87, 75, 92, 90. So where are we at the moment in terms of the share price? Well, we are currently standing, let me just bring this up for you. We're currently standing at 61, but we have been seeing the company having a bit of a tough time of late following a massive ramp up that we saw over the course of last year. So we're breaking lower, and crucially, we're breaking through this key support level that is down here at 62.91. The fact that we've broken through that level points towards further downside, the possibility that we're retracing this big move here. And so let me just try and, I mean, I don't think it's got the deep ones. Let's see where the 50 is. So yeah, we're roughly at the 50% retracement at the moment. Certainly, you know, as things stand, it looks like what a company that's likely to continue to move lower from here. We've got that lower high. Now we've got the lower low confirmed. We'll be following this on an intraday basis. And certainly if we see a break up through this more recent swing high, sort of around 65.80, and in particular 69.34, it starts to portray a little bit more of a positive picture. But as things stand, we've seen a sell-off, that retracement phase, the breakdown through your support around 68.31, and we've been sort of moving lower with the lower highs and lower lows on an intraday basis from there on in. So until that reverses, you know, the trend over the near term still remains a bearish one. But it's worthwhile noting that this is a company that's expected to turn a corner over the coming years, and therefore that move into profitability could provide the basis for strength. We already saw a really strong move higher over the course of 2023. Things haven't necessarily been great since that back end of Q1 of 2024, seeing significant losses. But, you know, perhaps this will provide a buying opportunity for some investors before too long. I would just say that if you're looking at this from an intraday basis, the trend still does remain bearish as things stand. We're looking out for something that might tell us otherwise. We have not seen that quite yet. And then finally, I wanted to highlight the likes of Walt Disney. Now, Walt Disney, if I highlight it on a sort of annual basis, you can see that there's an expectation that we will see gains coming over the forthcoming years. You can see 376 from 2023, expected to get up towards that $7 mark. So almost double where we are at the moment, expected over the next 4 years in terms of earnings per share. Well, you know, this is just a case of trying to get back to where we were pre-pandemic. You can see in 2018, it was 708 in terms of earnings per share. Then we saw 2020 down to just 2. And then we've been trying to claw back that ground ever since. So it's been a tough ride for this company. And certainly some of the job cuts that they have made in terms of their television business do point towards a need to continue to adjust the business going forward to attain that profitability and control margins. But nonetheless, we're looking for a continued gain over the coming years in terms of earnings. In terms of revenues, a similar kind of picture. We're at 88, 90, expected to go 91, 96, 100, 104. So steady gains expected on the revenue side of things, and even better performance expected on the earnings per share. In terms of the quarter-on-quarter basis, we can see here in terms of the earnings per share expected at 119. We compare that back to last year. That was a 103. So again, a nice healthy gain on a year-on-year basis. In terms of revenues, 2306. That is marginally higher than the 2233 that we saw last year. So gradual gains expected, nothing sort of blockbuster, so to speak. But we're looking at a company that is trying to sort of claw back ground. And Wall Street analysts are generally on side for this company. 6 strong buys, 17 buys, 8 holds, and just 1 sell recommendation. You can see in terms of the recent recommendations that have been put out to the market. Generally, they're a decent chunk ahead of where we are at the moment. This latest one from Loop Capital coming in at 130. That's a 38% premium to where we are at the moment. That's quite similar to the Rosenblatt Securities prediction that we saw, again, at 37% higher than where we are at the moment. So by and large, you can see Wall Street feeling relatively positive for this stock. But the big question mark is how has the company been faring in terms of its share price? Well, we can see, let's just bring that up in terms of the chart. We can see here that the chart has been struggling, to say the least. And this is the weekly time frame. You can see that this peak that we had here at around about the back end of Q1 has set about a sell-off that's really seen a protracted move towards the downside. And the question mark here is, you know, have we based out, or are we basing out here? You can see that, of course, we saw this COVID collapse the rally up from there, and everyone was probably saying, oh, this was a great opportunity to get into a stock that was a great performer prior to COVID. And, we saw the collapse, we saw the recovery and some. Then we've seen the sell-off back down to the COVID lows. And those COVID lows were roughly sort of 80 kind of mark. And we're now at 93. So arguably someone looking for value might look at this stock and say, I'm seeing value in this stock because we're pulling back down to a key area of support here. If we break back below that 80 threshold, then yes, it starts to look pretty troubling. But we're at levels that were respected in the past. We're coming in towards levels that were seen around COVID times. And of course, we're not in a pandemic right now. We don't have the kind of closures that there were previously. We've pulled back into the 76.4 fib, which is at 89. And we're starting to see a little bit of strength. Will this earnings report provide the basis for further upside? Well, I think there's a good chance that this is a bottoming pattern. It's taken a long time in the making, but we've just had months of downside leading into this. Let's hope that this earnings report can provide the basis for a bullish recovery for Walt Disney. It's certainly a big outperformer over the years in the past prior to COVID. COVID really knocked the socks off of it. But we've come back down into this big area of support that we can see here. Your 90 mark, your 80 mark. This zone has been respected time and time again. And I don't think there's a justification for us to get back down to the pandemic lows. So let's hope to see some upside from here, and certainly a move up through your first swing high, which would be around here at around about 98.72, would give us greater confidence that the bulls are back in charge. But until that happens, they're not. And that downtrend does still remain in play until we see a break up through that near-term swing high for Walt Disney.